Real estate investing principles. They are often misunderstood. And in this video, I'm going to lay it out for you. Things that people most need to remember about investing in real estate. I'm going to give you three different ways, three different methods of investing in real estate. I'm going to go over two different ways of thinking about your money in real estate. I'm going to give you some resources here toward the end of the video. And the very last thing on the video I'm going to give you is the number one rule to remember when investing in real estate. Hi folks, my name's Armand, realtor with Team Armand at eXp Realty. I've been helping folks buy and sell real estate investment properties along with regular houses and lots and whatnot ever since 2003. I've done a little bit of real estate investing myself, so I know a little bit of what I'm talking about. Like, comment, and subscribe to our channel to be the first to receive news about what's happening in the real estate market in your area. Okay, let's get into it. Three different ways to use real estate as an investment. First way is called buy and hold. That's your very, very typical real estate investor. Buys a property to rent it out and hold it for a very long time. There's a very good reason for holding it a long time. I'll tell you about that in just a second. The most important thing to remember is when you buy a property, it's got to be easy to rent and it's got to be easy to maintain. So that generally means a house is fairly new, in good condition, in a great neighborhood. Extremely important. The second thing to remember about the buy and hold idea is a way to evaluate whether or not something is a good buy or not. And a good quick way to do this is using something called the GRM. That stands for Gross Rent Multiplier. It's a very simple formula for evaluating whether or not the purchase price that someone's asking for a rental property is a good price or not. It goes like this. You take the gross monthly rent, multiply it times 12 to give you the yearly rent, take that number and divide it into the purchase price. So for example, let's just use easy numbers. Let's say gross rent is $1,000. That means your yearly rent is going to be $12,000. And let's say they're asking $120,000 for the house. You divide $12,000 into $120,000, obviously you come up with 10. Is that a good number? Well, actually that's a great number. The lower the GRM, the lower the gross rent multiplier, the better deal it's going to be for you as the purchaser. We used to see quite a few deals around here with gross rent multipliers of 8. They're very, very rare to find these days. 10 would still be very good. We're typically seeing GRMs around 14, although I will tell you that sometimes it's okay to invest in a 16, 18, even a 20 GRM, but only if you really expect massive appreciation on that property. It's really not advisable to go with looking for massive appreciation. I would stick with the 12 to 14 for a typical rental property purchase. Another good principle to remember with the buy and hold idea is they typically say you really need to manage 4 properties yourself on your own before hiring a property manager to manage your properties. The reason for this is you really need to get an idea of what it's like when somebody's renting your house. What kind of problems are occurring? When is a tenant a good tenant and not such a good tenant? What kind of things go wrong? And how to fix things when they go wrong. You need to do this yourself to really get an idea of the ebb and flow of how this works before hiring a property manager. That way you really know whether or not the property manager is doing a good job for you, because when they give you reports, it's going to make sense to you because you already have experience in managing at least 4 properties yourself. Speaking of managing properties, one of the most important things you'll learn to do is evaluating potential tenants. 2 things you got to do. You got to check credit and you got to check their criminal records. Don't get a tenant into your house without doing these things and evaluating them for sure. A great idea is to go ahead and start partnering with a good property manager even before hiring them. If they're good property managers, they're happy to have you reach out to them for a little bit of help here and there. For example, evaluating whether or not a property is going to be a good rental and what kind of rents you can potentially get at that property. I can give you some referrals for good property managers that I recommend. Finally, the last thing to remember about the buy and hold idea is something called a 1031 exchange, which applies when you want to sell that property. Or really, it applies when you want to actually move up into a bigger and better property. The 1031 exchange is designed to have you defer the taxes on your gain on that property. It doesn't prevent you from paying them, it just delays when you're going to pay those taxes. So if you want to sell a smaller property, take the gain on that small property and put it into a larger property, a slightly larger property, you've got to do a 1031 exchange. I'm not a tax advisor, so contact a really good tax advisor for more information about how a 1031 exchange works. The second basic way people make money in real estate investing is to do a flip, of course. Now, the problem with flipping is it typically takes about $50,000 these days to really revive a property to get it into a good shape. It could take more. $50,000, give or take, let's say $20,000. And a lot of that depends on the price point of the house you're going to buy. It's a big difference between how much you're going to need to invest in a house that costs $200,000 versus $500,000. So be aware of that. You got to have some extra cash on hand to do the fix-up for that house. Also, while you're fixing up that house, be sure to make your upgrades sensible upgrades. Don't go wild and crazy. Don't try to reinvent the wheel. Don't try to put really unique features in this property because you like them personally. Go vanilla, go neutral. Just do things that you think 80 to 90% of the renting public is going to like what you put in there. Be very sensible about your upgrades. The third way people make money in real estate investing is building. Buy a lot, build a house. Yes, it takes a lot of capital, it takes a lot of money, but it's a tried and true, proven way of doing it. Really, honestly, building is left to the sort of the big dogs in the real estate investing field, but it is something you might want to consider, at least aspire to, and get to it eventually. Now let's talk about the two different philosophies of real estate money. The first philosophy, which I personally ascribe to, is using all cash. Using all cash for your purchases gives you what I call the sleep factor. That means if something goes wrong with that property, you don't have this big massive mortgage hanging over your head while you're trying to fix the problem. Vacancy. You know, sooner or later, your rental property is going to be vacant. Or if you bought it to flip, you know, maybe the market kind of tanks or at least slows down. It takes longer for you to sell that property than you imagined or you counted on. Buying with cash alleviates that stress point an enormous amount. That's the first way, first philosophy of buying real estate. The second philosophy, though, and a lot of people do this, is to buy using other people's money. That means taking out loans, mortgaging yourself to the hilt. Now, one thing to remember is, if you're going to do that, you need to keep in mind you want the mortgage rate, the interest rate on your mortgage, to be lower than the appreciation rate that you're getting on whatever property you're building. So if you borrowed a lot of money and bought in 2021, 2022, you did great because you were borrowing money at 3 or 4 or even 5%, but the appreciation rate was 20% per year. If you did that, and then you sold by the end of 22 or into 23, you did really great. The problem is though that the appreciation rate really dropped off in 23. And here in 2024, appreciation rates in the triangle area were about 2 to 3 or 4%, depending on what region you're talking about. So borrowing money, mortgaging to the hilt, not such a great idea as far as my opinion goes. When looking to evaluate properties and your potential rental, besides asking a good property manager what this property could rent for, there's a great online resource I recommend checking out. And it is a website commercially run. Anybody can go to it. And you just take the city that you're in and add the word rent to that, all one word, like Chapel Hill Rent or Durham Rent or Raleigh Rent, singular.com. And you'll see a whole bunch of landlords and their property owners advertising their properties for rent. That'll give you a pretty good idea what the rental rates are going in any particular town, even any particular neighborhoods, if you really zone in and see what things are being rented for. So try that out. Chapel Hill Rent, Durham Rent, Raleigh Rent, or whatever city you're in, rent, all one word, singular.com. Check it out. Another good resource, though, is asking an agent like me to go into the MLS system. There are a lot of rentals being listed in the MLS system, and that can certainly give you a very good estimate as to what a property could rent for. And then finally, of course, develop a good relationship with a good property manager. They're happy to give you an estimate about what something could rent for because they're going to want to get your business eventually, sooner or later. Good resources. And as far as you advertising your property in chapelhillrent.com or what have you, that's always a great idea. I'll tell you what, the tried and true way of getting something rented is to simply put a for rent sign in front of your property. That really works even to this day. Talk about old school, a for rent sign. That will work. Okay, folks, you've hung with me all this time. I'm going to finally reveal to you the number one thing to keep in mind when thinking about real estate investing. And this is the number one rule to remember, and that is you make your money when you buy. That means whether you're talking about buying a buy and hold or a flip or even a building on a lot, getting a great deal on the property that you're buying is essential. Don't play top dollar and then hope you're going to make it back with appreciation or high rent rates or something like that. You really got to look for the diamond in the rough, look for a great deal on a great property. I get investors calling me all the time because I sell a lot of properties. Investors calling me all the time asking if I have properties that they can buy. But they're always looking for to buy a property at least 70% off market rate. And I'm not going to represent a seller and sell that property to them for 70% off market. But that's what they're hoping for. That's what they look for. They're out there in the public, and that's why they're sending all these letters to everybody and their brothers asking if you want to sell their house. And then you ask them, well, sure, I'm happy to sell my house. How much are you going to pay for it? It's always about 70% of market rate. You make your money when you buy. That's really, really essential. Folks, obviously there's a lot more to this. Please contact me for more information. If you're looking for an investment property here in the Triangle area, my team and I are happy to help you. My full contact information is down below. We look forward to hearing from you soon. I appreciate your time. Thank you. Let me know what questions you've got.